this ECB has come to even thinking about raising interest rates. That's the opening bell in New York City. Good morning to you all. Let's whip through it. Euro dollar spikes higher, up 0.7% on euro dollar 113.83 as we bring forward the prospect of interest rate hikes of the ECB, at least the thought of it. This is what it does to the German debt market. Switch up the board and get to Bunds. Bund yields higher at the front end and right through the curve. On twos up 6 or 7 basis points, now negative just 39 basis points on German twos. The depot rate of the ECB still negative 50 basis points. The problem might be in Italy. Switch up the board and get to BTPs. Your 10-year yield in Italy higher by 15 basis points at the front end, up by 14. At the epicenter of this news conference, these comments from President Lagarde on inflation.
There was unanimous concern around the table of the Governing Council about inflation numbers. We are all driven by the same mandate, which is price stability. And we are all concerned to take the right steps at the right time.
That got your attention. This is how she clarified those concerns.
What I'm saying here now is that comes March, when we have additional data, when we've been able to integrate in our analytical work the numbers that we have received in the last few days, we will be in a position to make a thorough assessment again on the basis of data. And I cannot prejudge what that will be.
Let's get across to Manus Crani in Frankfurt, Germany. Manus, I'm so happy you're with me today. You and I have covered this for a long, long time together. I'm not saying they're there, but Manus, they're getting closer.
To quote Lagarde, I don't make pledges without conditionality. She was asked, would she repeat, very unlikely to raise rates. That's the trigger phrase that we were all looking for. She wouldn't repeat the phrase. She warned on conditionality. She bought herself time. There's a lovely line on the blog, which is that the bond market, as you said, 2s, 5s, 10s, all sweeping higher from Germany down into Italy. The belly of the curve is moving the most. And this is where the bond market is laying down the gauntlet, because they're reading this situation has changed and inflation is tilted to the upside as being a paraphrase for I've got optionality, but I'm not going to do anything until I make the new decision in March. I told you, Jonathan, it's two very different economies, and she was very definite about that between what's going on in your economy in the United States of America and here in Europe on a fiscal and a wage front. But the euro is flying higher, and it looks like this market is going to be pushing further and harder and baying for higher rates. Jonathan.
Manus, just a final question from me to you. There is a process here, and before we get a rate hike, we've got to wrap up QE. How important is that going to be in the coming months as we start to hear from the ECB speakers?
Jonathan, that's a global issue. It's not just the ECB. They've got to roll off their emergency PEPP. That's the pandemic purchases, then sort of cozy the market a little bit with APP, asset purchases, at 40 billion. So that's, as it were, the blanket that they're going to offer to this market. But Jonathan, it's about whether you've got active QT, passive QT, or something that we really just don't quite understand yet. And that's what Credit Suisse are talking about this morning. You could have an ugly version of QT, Jonathan, and we just simply don't know whether they're going to do that in the US or here. I think she's buying time, but the rates market is showing utter impatience.
It's screaming right now for something. Manus, thank you so much. Manus Crani out of Frankfurt, Germany. They have the line, That T word in Frankfurt, crumbling, transitory. Can you hold on to it? In Frankfurt, Germany, the ECB right now. Joining us, a fantastic panel. Invesco's Alessio De Longis, CreditSights, Winnie Caesar, and Eric Nelson of Wells Fargo. Winnie, first to you, your reaction to that news conference over the last 60 minutes.
I think it's not a particular surprise that we are extending our focus on inflation across the globe, because so many of the inflationary drivers are global and related to the pandemic, supply chain, commodity prices. I think there are some nuances in that conversation around addressing inflationary pressures through rate hikes may not be the best mechanism to really bring down inflation. But just given how low yields were across the globe, seeing this type of rates market volatility is not a particular surprise if investors continue to perceive central bank messaging as incrementally more hawkish.
I want to turn to you, Alessio. It's been a while, but before we get there, they've got to wind down QE. Alessio, is that the next step here before we run away with a rate hiking cycle at the ECB?
For the ECB strategy, certainly it's the best approach and it's the best way to go. This is the most meaningful hawkish innovation coming from the ECB in a really, really long time. So they really cannot afford to get this communication wrong. They cannot afford to be confusing about the sequencing. Hence, the postponement to March makes absolute sense given their delivery process. It's a market that is pushing central banks as they always do. Bond markets lead central bank actions, not the other way around. And bond markets are telling central banks globally, look at where we were in Q4 of 2019 before the pandemic. We ought to take rates back to that level and then reassess. Because ultimately, inflation is above target, very well above target. And the growth side of the economy, the unemployment side of the economy has adjusted. So it's very difficult to continue to drag your feet at this stage.
5-6 minutes into the session, one thing stands out apart from the ECB. Facebook, as it has been all morning, down by more than 20%, dragging down the index on the S&P. 6 minutes into the session by 1.4%. Big weighting on the Nasdaq coming into today. It was 5% of the Nasdaq 100. We are lower there. We are down hard. I want to bring in Ed Ludlow from San Francisco for a little bit more on this from the West Coast. Ed, a disappointment. We saw it happen to Netflix. It happened to Facebook after the close yesterday.
I mean, what do you even say? We've just lost more than $200 billion of market value, and you ask the question, is this just killed the rally in tech stocks and equities, and it's dragging the rest of social media and advertising stocks down with it, right, John? Come with me straight into my Bloomberg terminal and look at this chart. This is the story. This was the quarter that Facebook stopped growing. The yellow bars are the quarterly monthly active user growth. The blue line you see down the bottom of your screen says zero growth. And we all got together last night, the editors and beat reporters, and said, has anyone ever seen this? And the answer, John, is no. Headwinds on the growth, TikTok and YouTube. They're stealing the attentions of young people who are no longer going to the Facebook platform, but they're also impacting the growth of Facebook or Meta's other platforms, Instagram and Reels. So this is a big problem for the company.
Ed Ludlow on the West Coast, a big problem for the company and for anyone who holds the stock right now. In D.C., the Senate Banking Committee holding a confirmation hearing for President Biden's Fed nominees. I understand that the Republican Senator, Pat Toomey, speaking right now. Let's listen in.
Maximize the speed and safety of a move into a sustainable, durable, net zero economy and away from climate change disaster, we need to use the financial regulatory apparatus to engage financial markets and financial institutions in affecting both direction and pace, end quote. In June of 2020, the Saris report came out and you wrote, and I quote, at the very least, we must rebuild with an economy where the values of sustainability are explicitly embedded in market valuation. This transformation will come in part from urging the leaders of our financial regulatory bodies to do all they can, which turns out to be a lot, to bring about the adoption of practices and policies that will allocate capital and align portfolios towards sustainable investments that do not depend on carbon and fossil fuels, end quote. How is that not advocating that regulators pressure the financial institutions to allocate capital the way the regulators want?
Well, it is, of course, not the role of the Fed to be directing credit allocation. They do not choose winners and losers. The way supervision works is by looking at risk, and by looking at risk wherever it may arise. You look at that risk, and you have to do it in a very, honest way, and ask yourself whether there is any correlation between that risk and the ability to hurt a financial institution.
Are you saying you no longer hold these views that you've stated about allocating capital as a result of your perception of this risk?
My views have been consistent, Senator. The Fed should not pick winners and losers. They should not be exposing taxpayers to undue risk.
Well, so okay, I'm sorry, that there is no reasonable reading of these articles and speeches that can come to a conclusion other than that you want to be allocating capital away from those industries that are generating large amounts of CO2. I'm sorry, I know you're saying something different here this morning, but that's not what you've been saying in writing for several years now. Let me move over to Professor Cook. I've heard you talk about the importance of getting inflation under control, but we had a phone conversation a couple of days ago. In that conversation, I specifically asked you whether you agreed with and supported the Fed's recent decision to gradually begin the process of removing the ultra-easy money policy, or whether you thought they were acting prematurely. And what you said was, well, somewhere in between. So I'm wondering if you can clarify that. Well, let me ask a simple question. Do you now support the Fed's current path of accelerating the tapering and moving on to a series of interest rate increases over the course of this year?
Senator, thank you for that question. I am certainly, when I think about these issues, I would like to look at the data and evidence that would be at one's disposal, if confirmed, to be able to make a decision about this. So I did say it was somewhere in between before, and I agree with the Fed's path right now as we're speaking. But when we get to a decision point, I would look to the data, the evidence that would be made available at that time.
Okay, well, there's a tremendous amount of data that's out there, right? I mean, there's no secrets or mystery about what the Fed's monetary policy is at any point in time. There's no secret or mystery about economic data generally. There's thousands of people across the country that are constantly analyzing it. It seems you've shifted from the in-between answer to now saying you support what the Fed's doing. It's confusing to me, and so could you give us some sense of how you view the policies that are available to the Fed, how you think about what we should be doing at this moment? Have your thoughts on the Phillips curve changed given the developments in recent years? Are you concerned about the change in what's happening with the shape of the yield curve? Do you think exchange rates are an important mechanism? How do we get inflation under control?
Thank you for that question, Senator. I understand that every day Americans are suffering from high inflation. This is something that I learned a lesson about more recently, probably than most people. I've lived in countries and advised countries in a situation of hyperinflation. So I am motivated by seeing the suffering of workers, of businesses, and just trying to plan their everyday lives and facing an inflationary environment. The way I would think about it would be, along with, if confirmed, along with the deliberation. So you're right, there's a lot of data available, we don't have access to all the data the Federal Reserve has, but we have a lot. And what we don't have access to is the deliberations at the time that they're being made. And I work collaboratively. I'd like to hear arguments as they are being made. And with respect to the shape of the Phillips curve, what we know in economics is that this is an open research question. We know that there's a trade-off between unemployment and inflation, but we don't necessarily know what that relationship is. And in times of uncertainty, and this is sort of my specialty, in places of uncertainty in emerging markets and developing countries, what we know is that we have to be patient with the data. We have to ask about the data, whether the data have changed, if they are reliable, and still valid. So I would make sure that I pose questions of the data we were receiving and engage with the deliberations with my colleagues with an open mind, if confirmed.
Thank you, Mr. Chairman.
Thank you, Senator Toomey. Senator Reid from Rhode Island is recognized.
The Republican Senator Toomey of Pennsylvania questioning the White House Fed picks in the Senate Banking Committee testimony hearing. Let's get you to Michael McKee for a little bit more on this. Morning, Mike. We've got to talk about this and the economic data that drops in about 10 seconds.
Yeah, we got a lot going on this morning, John, that will affect trading. We're waiting now for the market services and composite PMIs. They had slowed in their preliminary numbers. The final numbers for the month of January just out, with services at 51.2. That's up from the 50.9 preliminary. And the composite at 51.1, up from 50.8. So as the month went on, it appears conditions got a little bit better, particularly in service industries. May not affect what people think, probably won't affect what people think will happen tomorrow with the January jobs report, John, but it is an indication that there probably was an Omicron impact that may be fading now.
Mike, tee us up for payrolls tomorrow. What a fascinating data point for a lot of people to get through.
It is fascinating because there's a feeling that we may even see a negative number because at this point the Omicron variant kept a lot of people home. Now the forecast consensus is 150,000 and you notice the other numbers don't move from last month. So it looks like stasis for the committee. It's a very, very wide dispersion from 250,000 jobs all the way down to negative 400,000 jobs in terms of what people think may happen this month, and there's the cluster is around 120 to 150, so we'll see if that turns out to be correct. But I do want to point out one change after that big ADP report yesterday, the big drop in ADP. Look at what happened with Morgan Stanley. Morgan Stanley went from 235,000 positive jobs to a negative 215. So it does look like some minds were changed on Wall Street by the data as they come in. And if we get anything like a negative number, be interesting to see how Wall Street reacts, whether they've priced this in or not.
I read that note from Ellen Zentner last night. Fascinating stuff. Mike, thank you. Back with us, Alessio De Longis, Winnie Caesar, Eric Nelson, thank you for your patience, sir. We've left you out. I'm going to come to you now. Eric, talk to me about the situation in Europe and the United States and why the central bank response at the moment seems to be so different.
Well, John, it's been different for a long time, right? And particularly in Q4 and earlier this year, we had a massive shift from the Fed toward more hawkishness, 4 to 5 hikes, possible balance sheet reduction, and the ECB was still hanging on to will they or won't they end the pandemic emergency purchase program. That is shifting, though. Just as we heard from Lagarde this morning, the situation has changed in Europe. So there is, in contrast to what we saw back in 2014, 2015, some degree of convergence or at least co-movement between the U.S. and the European central banks. The big question, though, in my mind is how high can these central banks get in terms of their terminal rate? To me, the ECB is about getting back to zero, whereas the Fed, I think, can hike 4 or 5 times, start balance sheet reduction, and then keep going. So to me, that means that euro over time is still biased lower, even if it moves sideways in the short term.
In the short term, right now, we're seeing some massive moves in this market. Facebook down by 26%. This is a monster move in the equity market. Alessio, I want to come to you. I saw this with Netflix. I'm seeing it again with Facebook. These are super caps. They're mega caps. Alessio, they're moving like penny stocks off the back of earnings. And I wonder for you whether you look across the equity market right now, whether these are single name stories or whether there is a broader story here off the back of it all.
Well, right now in the short term, I think there is a little bit of both elements. Obviously, having had earnings releases on these specific names, the idiosyncratic factor, the idiosyncratic component overnight today is massive. What is the other side of it? Because of the global hawkish rhetoric by central banks and the bear flattening that we're seeing across many, many curves, this is, in the short term, runs the risk of becoming a little bit also of a broader theme. And the broader theme is expensive growth companies see a valuation derating because those cash flows are now being discounted at simply higher interest rate. So that's a little bit where the nexus of these two themes really come together. Now, on a forward-looking basis, we think that as long as we don't get a bear steepening in the curve, in other words, where rising bond yields are led really by the long end of the curve, we think that a return to quality outperformance over value, and by quality we mean not necessarily expensive growth stocks, but rather large profit margins, large return on assets, coupled with low volatility characteristics, will allow mega caps and large caps to outperform small caps, mid caps, and value. Because ultimately we're going into an environment of flattening yield curve, tightening financial conditions and slowing growth, I would still choose quality over value.
Winnie, I want to come to you on both what we're seeing in the equity market and in credit too. We're seeing some real-time destruction to some massive companies, losing close to $200 billion worth of market cap. Click of your fingers, just like that. We've seen some companies add just as much. Alphabet yesterday was on fire, Apple the week before. Winnie, do you see anything like this developing in credit? This kind of destruction, these kind of big moves?
In credit, the type of destruction that we've seen has been material, not to the extent as in the equity market, but January in both U.S. investment grade and high yield was the worst start to the year on record, and on a total return basis ranks in the top 20 for both asset classes for worst monthly return performance. So we are seeing some erosion on returns and some dispersion across the market. But like equities, it's been very technical and rates driven, with kind of a repricing of expectations of where rates are going to go, rather than this pure fundamental, liquidity is being cut off, we're going to see downgrades, we're going to see defaults. That has not materialized yet in the credit markets. So I think that there are some similarities, but credit in general has been a little bit better behaved, which actually is a kind of encouraging sign for equities longer term.
Eric, can I pick up on that with you and just get a final word on it?
Yeah, John, I think the key thing for the broader market here is the training wheels are off. The central banks have shifted in a big way, and it's been a global phenomenon. So whereas at the end of last year, we were looking at a very favorable both fiscal and monetary environment, that's no longer the case. So we're likely looking at more volatility in store this year, more back and forth moves, and to me that supports more curve flattening and more dollar strength.
Thanks to all three of you for your patience this morning. A ton to get through, I know. Winnie Caesar, Eric Nelson, Alessio De Longis. We'll get you back on soon for a longer conversation. Ed, I wanted to save about 90 seconds for you on the West Coast. Ed Ludlow joins us now just to talk about what's happening with this name, Facebook, down 25%.
Right. Yeah, headwinds to user growth, which is competition like we talked about a moment ago, John, and headwinds to revenue growth. Ad spending is down, suppressed by supply chain issues, suppressed by the Omicron variant. Because of the Apple privacy tracking changes, small businesses, which we forget is a mainstay for the Facebook platform, were confused because they didn't have the data available to plan their ad budgets. That's one thing, but read across Wall Street, right, and Luke Capital Markets say, while financial results were not terrible, the outlook was. The market spooked. But you also look at the longer term, right, and the market coming to the realization that the metaverse isn't here. The metaverse is distant, but it's very expensive. That unit, Facebook Reality Labs, posted a loss of $10.3 billion in 2021. Bloomberg Intelligence saying that 2021 loss will translate into 10 percentage points of margin erosion in 2022. You look at JP Morgan, one of the biggest bulls on this stock since it IPO'd in 2012, downgrading. How much pain threshold is there, John, for this?
Ed, thank you. I have no idea. We're down 25 on Facebook. We're down 5% on Amazon. A little bit later after the close, we get Amazon. And given what's happened with the price action recently, if you don't give a good guide, a good forward look, you get hammered. Facebook, a big example of that this morning. Up next, we'll run you through the trading diary. It's not just Amazon you need to look for. It's also payrolls too. That's the big one tomorrow. From New York City, this is Bloomberg.
Brilliant.org/TV.
25 minutes into the session, it's tough out there. On the S&P, we're down by 1.6%, down more than 2% on the NASDAQ. Here's your one big reason. Facebook, after the close yesterday, coming into the session now, down 25%. Biggest one-day drop in the history of this company as a public company, down more than $200 billion in market cap. Just like that. That's the price action. Here's the trading diary. More earnings after the ban, including Amazon on Friday. The main event is payrolls tomorrow in America. Looking ahead to next week, the trade balance data Tuesday. The big one, CPI. Another reading of that and additional jobless claims out on Thursday, plus tech earnings throughout the week with Twitter still to come. From New York City, it's one of those. Deep breath. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Last year, more homes canceled cable TV than ever before. Why? It's just too expensive. For half the price of cable, you can get Fubo TV and watch the live sports and TV you love. Try free at FuboTV.com.
Want to increase your home value? Find out what it's worth first.
Just go to Ownerly.com, enter the address, and see the home value instantly. Come to Ownerly.com and see what your home is worth.
Scribd is my time to listen.
I can listen at home, in the car.
It's a way for me to stay informed, get entertained.
Scribd is ebooks, audiobooks,
magazines, podcasts.
Scribd, it's awesome.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, February 3rd. Here are the top market stories we are following for you at this hour. Let the hawks fly. The BOE hikes 25 basis points, but 4 dissenters wanted more. Lagarde doesn't rule out an ECB hike this year, noting upside risks and unanimous concern about inflation. Yields and the euro soar. Meta's mega drop, faltering user growth and a weak forecast send the stock plummeting 25% toward the biggest market cap wipeout in history, taking the NASDAQ down with it. It sets the tone for Amazon reporting post-market. And in the hot seats, President Biden's Fed nominees face tough questions from senators in their confirmation hearing on Capitol Hill today. Republicans zeroing in on Sarah Bloom Raskin and her views on bank regulation and climate. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, what a day.
Honestly, it's one of those days where I don't know which way to look. You've obviously got the Meta news overnight. That's epic. You then get into the Bank of England. Everybody expected 25 bips, but there is talk of 50. 4 potential members of the MPC potentially looking at 50. Then you get into the ECB in the press conference, and Christine Lagarde just unable to repeat the phrase that she talked about in the last press conference about how unlikely it is the rates are going to be going higher in 2022, as a result of which massive moves in equity markets and bond markets and foreign exchange and credit. It just goes on and on and on. So it is definitely one of those days. Let's add some bits and pieces into the mix. Markets, actually the ISM data hitting the screen right now. This is the services number, 59.9. Now that's down from 62.0, but we're dealing with Omicron right now and the service sector more exposed to that. The expectation was 59.5 at the headline level, so a little bit better than anticipated. Factory orders come in bang in line with expectations. Durable goods a little bit better than anticipated, but only at the margin. But nevertheless, it looks like the service sector has taken a hit, but maybe not as big a hit as anticipated. Just one of the other pieces of data that we're throwing into the mix as we think about where central banks are going to be going next, Kaylee. The European Central Bank President, Christine Lagarde, as I say, finishing speaking in her news conference just a little while ago. The ECB renewing its pledge to withdraw pandemic stimulus gradually, but only really kind of shifting the ground quite significantly, I guess you probably would put it, in terms of the hawkish narrative. Joining us now to discuss all of this is our executive editor for Bloomberg Economics, Simon Kennedy, joining me now on set. Very nice to see you on set. I haven't seen you for ages on set, so nice to see you. Let's talk about the Bank of England and the ECB, both more hawkish than anticipated. In terms of the bigger surprise, where did it come from?
I think the Bank of England. I think you've got a 9-member policy panel, and 4 of them voted for 50 basis points. And there's not really been much discussion about 50 basis points in the UK. There has been in the US at the Federal Reserve, and actually the story there is officials pushing back against that narrative in markets. There wasn't really an expectation of 50. The bank had already started. It started with 25 in December, and so suddenly to put for 4 policymakers to put a 50 rate hike on the table and have Andrew Bailey, the governor, effectively casting the deciding vote, I think it resets a little bit of the Bank of England expectations. We already thought they were hawkish. We already thought they were the most hawkish when you look at the group of 7 that already raised rates. None of the others have. But today it was like, some want to go by 50, which, as we were discussing beforehand, kind of puts that idea of consecutive consecutive hikes on the table. 3 consecutive hikes. We've just seen 2. A third, if you wanted 50 today, you're definitely coming back next time for the rest of that, and maybe one of the majority today moves into to the kind of the 50 over a couple of meetings hikes. So certainly the only way is up for UK interest rates.
Well, okay, but let's talk about Christine Lagarde, who you said was the less surprising. Did she become a hawk today, or was she just unable to be quite as dovish as before?
I think she's in a bit of a bind. I think the expectation going into that meeting, and our colleagues on the markets team may have a different view, was that she would hold the line and she would kind of maintain this very strong line against tightening of monetary policy this year. And it looks like she just didn't feel quite able to do so. We had that big inflation surprise yesterday, gains in prices much faster than expected across the euro area. So today to then kind of stand and kind of repeat the mantra that she's used before about not hiking in 2022 or unlikely to hike in 2022, she could then be accused of a bit of a credibility problem. Yep. So it could be that actually she kind of shored up the ECB's credibility. It didn't hike. It maintained the stimulus. But with her rhetoric, which was certainly hawkish in many different ways, not just the not refusing to repeat that language she's used before, she's potentially held the line a little, and that provides her with some time. But again, the markets are betting on a far much, as with every central bank globally, yep. The markets have been betting they would act more quickly, and they've eventually had to do so. So I think Deutsche Bank is a December hike, but that's still a hike. That's still many months away before they have to make that decision.
Yeah, if you look at market pricing, potentially we could be looking at hikes kind of mid to late summer, which would be certainly well before what we were expecting only a few weeks ago. In terms of the March meeting, that's when we get the next set of staff projections. The data they're plugging in at the moment, the cutoff comes fairly soon. Is that now the critical meeting? If we continue to see the data moving in the wrong direction from an ECB point of view, are they going to have to change the tone significantly more in March?
Well, again, we just have to wait and see you into kind of this holding pattern. But yeah, that's the direction of travel. And so if you're looking, I think the markets are pulling forward that betting into the July territory to get to hike in July. They've got March, then they've got June with forecasts. And so you see the forecast in March, and again, you start to think about whether they're going to have to lay the groundwork for a hike in the summer. They get March, they get June. If the data continues to lean against them, they're going to struggle to maintain the approach they entered the year on.
All right, Simon Kennedy of Bloomberg Economics, thank you so much. And I'm glad, Guy, that Simon and you brought up market pricing, because the power of the Bloomberg terminal is it can beautifully illustrate that. Let's take a look at the pricing for the Fed, the BOE, and the ECB. We can see on a different chart, this is, of course, the move we are seeing in gilts, which is absolutely incredible. Today we're higher by about 12 basis points on the 10-year gilt yield, but you also have seen traders pulling forward their bets. Now a 10 basis point hike from the ECB by June, ending the year 40 basis point higher for the ECB. We're now out to 125 by year end. Joining us now for more on this market reaction is Bloomberg's Christine Aquino. Christine, this has been very dramatic. Why was the market so taken aback today?
Well, Kaylee, I think it really was all the punchy comments and very hawkish in very different ways for the BOE and ECB, but still very hawkish signals from both of them coming today. And it has really outdone what markets were already expecting, which of course was already leaning quite hawkish heading into today's decisions. Of course, that BOE vote split, very much a hawkish signal that markets are really latching onto. Likewise, Lagarde's language around the possibility of rate hikes, and that she was unable to repeat that they're not very unlikely, which is quite a difference from the last time that we heard from her. And markets really just took this as permission to pull forward those rate bets for both central banks and expect more by the end of this year.
Christine, one of the things that is going to be tricky in this scenario is for the ECB to figure out how it's going to manage its PEP program, the asset purchase program. Presumably they have to finish before rates go higher. And if we're talking about rates going higher, kind of, let's say, the summer this year, then that whole process is going to have to be significantly accelerated in terms of the taper. How realistic is that? Just talk me through the market mechanism of making that happen. That will be a significant withdrawal of stimulus very, very quickly.
Absolutely, Guy. And I think, as Simon alluded to earlier, they really have a lot of ground to make up for when it comes to signaling that if they're going to be sticking to that sequencing pattern of ending their asset purchases first before any sort of rate hikes. And so they're going to have to rethink that strategy potentially over the next few months if the markets keep backing them into a corner when it comes to rate hikes. And again, potentially needing to communicate that much earlier and perhaps a much faster pace of withdrawal. We already saw what happened in bond yields today, multi-year highs for the German 2-year and 5-year yield particularly. And so if we see the accelerated pace from the ECB, expect more of that price action over the next few months.
Christine, great stuff. Thank you very much indeed. Big moves happening. You've got BTPs up by 16, 17 basis points. You've got the German 10-year not up by quite so much. You're getting spread widening. We're also now getting that kind of post-press conference calibration that we often get from the ECB as things are kind of finessed a little bit. The ECB, according to our reporting, is said to be preparing for a potential March policy recalibration. Recalibration, classic ECB type of language, basically signaling, Kaylee, that potentially a significant change in policy could be on the way. But that will have huge ramifications, both in terms of the credit markets, the bond markets, foreign exchange markets, equity markets by extension. Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas, joining us now. She says the Fed will not over-tighten and choke off the economic recovery. But what we're now starting to see is some competition, Gargi, for the Fed from other central banks. The Bank of England getting very close today, within a hair's breadth of a 50 basis point hike. We've got now the ECB recalibrating potentially in March. That's a significant shift as well. How surprised are you that we are now starting to see rapid catch-up from Europe? Maybe less so from the Bank of England, which is always sort of on the hawkish stance, but the ECB certainly.
Good morning, Guy. Thank you for having me on this really tumultuous day. So I think what was interesting about the ECB meeting was, it's the lack of two words that really caused this massive move in BTPs and bonds. The fact that Christine Lagarde could not say highly unlikely in terms of whether an interest rate could be possible, an interest rate hike could be possible in 2022. And I think just as we sort of try to, deal with what that might mean for the market, what it also means is for the sequencing. What does that mean for the APP program? What does that mean for purchases of bonds between now and, when that ends? So I think that's what the market is grappling with. Was it surprising? I think so. I think, especially if you were comparing it to what you were thinking about in terms of maybe a week ago before we got that inflation data. But I think Christine Lagarde is in a really difficult place right now with inflation data being at the highest level since the formation of the EU. So on one hand, she has to acknowledge that, but on the other hand, I obviously don't think that she meant for the market to have the kind of outsized reaction that it has had so far.
Yeah, and that's just one part of what is an absolutely wild market day. So we're going to come back and talk technology in just a minute. Gargi Chaudhry, BlackRock head of iShares investment strategy for the Americas, will be staying with us. And we're going to look at Meta in particular, the stock absolutely cratering, dragging down U.S. tech stocks. We could be looking at the greatest market value wipeout in history today. We will talk more about that next. And of course, we also have one eye on Washington. We are expecting remarks from President Biden eminently regarding the death of ISIS leader Abu Ibrahim al-Hashimi al-Qurashi. We will expect him to be speaking momentarily, and we will bring you those remarks when we get them. This is Bloomberg.
Season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
People have a lot of choices.
for how they want to spend their time. And apps like TikTok are growing very quickly. And this is why our focus on Reels is so important over the long term.
That was Meta CEO Mark Zuckerberg addressing the company's challenges. So this brings us to our question of the day. Did Meta wreck the rally? This stock is now down 24% on the day, taking tech down with it. Let's pose this question to Gargi Chaudhry, BlackRock head of iShares Investment Strategy Americas, as well as Bloomberg's tech correspondent Ed Ludlow in San Francisco. Ed, let's start with you. This is absolutely brutal. You do not usually see a mega cap stock moving in this way. Is this so much about the results and the outlook we got from Facebook overnight, or is this about a fundamental question as to whether its business model is going to work going forward?
Both, and yes on your question.
All right.
I mean, you know, I sat down late last night. I've been in for hours reading all of the Wall Street notes, and with the greatest respect to the sell side, did everyone expect the metaverse to arrive in January of 2022? Because quite clearly that's not what's happened. The outlook, yes, in the near term was worrying. That chart says it all. Growth for Facebook.com is over. Growth is at 0 on a monthly active user basis. But the more telling sign was the acknowledgement from the street of this multi-year horizon for the metaverse. You know, a $10.21 billion loss for Facebook Reality Labs in 2021. Bloomberg Intelligence is saying the worry there is that that translates to 10 percentage points of operating margin erosion in 2022. The metaverse is distant and it's very expensive right now. And by the way, just very quick, guys, I've been on so many earnings calls and many briefing calls with Mark Zuckerberg, and I've never heard him speak so candidly about the headwinds to growth and the headwinds to advertising revenue.
Ed, just sticking with you for a second. I appreciate what you say about the metaverse being a long way off, and I think probably people's timelines were a little skewed there. But nevertheless, the impact of Apple's decision on tracking seems to have had a massive impact here. Is this a Meta story or an Apple story?
Yeah, that's a really great point. And also, you know, Facebook or Meta ended 2021 with $100 billion of revenue for the first time. They actually beat in the fourth quarter. It was the outlook for the first quarter that was poor. Apple and privacy tracking changes are a problem. Remember, the Facebook.com platform relies very much on small businesses.
Yeah.
Small businesses relied on that data generated, third-party data, to inform their ad spending. They don't have access to that data anymore, and that was a real headwind, as was supply chain disruption, as was Omicron. So the advertisers generally pulled forward spending and are holding off now.
Gargi, let's bring you back in here. If big tech falters, can the U.S. equity market survive that?
You know, it's a really interesting question that you have posed to us. I think, you know, obviously the Facebook earnings yesterday are very important, but I think we have to take the broader context as well. So what we're also getting in the U.S. is a Fed that is likely going to start raising rates very soon and is indicating that they'll raise rates very fast and they'll be very nimble around it. And I think the fact that real rates have moved from, call it negative 120 basis points to about negative about 60 basis points in a very short span of time is also another driver of tech. And what has, I mean, if you if you chart it on Bloomberg in terms of what some of the NASDAQ has done versus real rates, you can see that correlation being really, really high. And I think to the extent that we still expect real rates to remain negative, I think we shouldn't lose focus on tech broadly. But where we decide to move in tech is important. So we think quality tech still makes a lot of sense going forward.
But tech generally, and this doesn't apply to all tech, but it is a kind of umbrella thought. Tech generally is about tomorrow. It's about the ability of these companies to produce significant revenues in the future. And that's now being challenged, Gargi, on two fronts, as you say. Not only on the Fed front, because you've got the discounting factor that you need to bear in mind here, but also on the fact that earnings may be not showing up in the way that people expected further out. In terms of the kind of the 1-2 punch here, which is having the bigger impact? Is it the fact that actually Facebook is saying, Meta is saying, you know what, the metaverse is a long way away and it's going to take a long time to get there and it's going to be expensive to get there? Or is the market reacting, given the backdrop of the Fed, to the Fed more here, saying, you know what, actually, with the discounting factor that we need to bear in mind here, any kind of a miss, any kind of a wobble is exaggerated and amplified?
I think if you look at this week, it's been both. So obviously we're focusing on Meta today, but if we think about what happened earlier this week, we had very strong earnings from Alphabet, and that obviously was a big driver of markets earlier in the week, and Apple before that. So I do think that we're entering this slightly more volatile period with so many central banks in motion and likely to continue to be, where earnings will matter a lot more. Fundamentals will matter a lot more when we enter into this tightening cycle, or at least we move away from an easing cycle. So I think that's important to keep in mind. However, I think the view that all tech should be eliminated from your portfolio broadly, that all tech should move in similar fashions, is a wrong one. And we just wrote a piece about this in terms of detect, don't detech is what we called it. And here we think that investors should really think about the quality companies, focusing more on those companies that are aiding digitization. So looking at companies that have better pricing power, looking at companies that have better margin resiliency, and then separating that from those companies. You talked about sort of the metaverse earlier and the unprofitability of it so far. So really separating that from the unprofitable growth companies, which we think in a rising real rate environment can still suffer.
Gargi, we're going to leave it there. Thank you very much indeed. Gargi Chowdhury joining us from BlackRock. Ed Ludlow, thank you very much. The president is in the Roosevelt Room making remarks about the action in Syria last night.
Of ISIS, known as Haji Abdullah. He took over as leader of ISIS in 2019 after the United States counterterrorism operation killed al-Baghdadi. Since then, ISIS has directed terrorist operations targeting Americans, our allies, and our partners, and countless civilians in the Middle East, Africa, and in South Asia. Haji Abdullah oversaw the spread of ISIS-affiliated terrorist groups around the world after savaging communities and murdering innocents. He was responsible for the recent brutal attack on a prison in northeast Syria holding ISIS fighters, which was swiftly addressed by our brave partners in the Syrian Democratic Forces. He was the driving force behind the genocide of the Yazidi people in northwestern Iraq in 2014. We all remember the gut-wrenching stories, mass slaughters that wiped out entire villages, thousands of women and young girls sold into slavery, rape used as a weapon of war. And thanks to the bravery of our troops, this horrible terrorist leader is no more. Our forces carried out the operation with their signature preparation and precision, and I directed the Department of Defense to take every precaution possible to minimize civilian casualties. Knowing that this terrorist had chosen to surround himself with families, including children, we made a choice to pursue a special forces raid at a much greater risk than to our own people, rather than targeting him with an airstrike. We made this choice to minimize civilian casualties. Our team is still compiling the report, but we do know that as our troops approached to capture the terrorist, in a final act of desperate cowardness, he, with no regard to the lives of his own family or others in the building, he chose to blow himself up, not just to the vest, but to blow up that third floor, rather than face justice for the crimes he has committed, taking several members of his family with him, just as his predecessor did. I'm grateful for the immense courage and skill and determination of our U.S. forces, who skillfully executed this incredibly challenging mission. The members of our military are the solid steel backbone of this nation, ready to fly into danger at a moment's notice to keep our country and the American people safe, as well as our allies. And I'm also grateful to the families of our service members. You served right alongside these soldiers and sailors, Marines, Special Forces, the loved ones, giving them the strength and support they need to do what they do. To our service members and their families, we're forever grateful for what you do for us, and we owe you a debt. Thank you. We're also aided by the essential partnership of the Syrian Democratic Forces. I want to commend our dedicated intelligence community, the Department of Defense, and members of our national security team throughout the government, whose meticulous and tireless work over the course of many months ensured that this mission succeeded. This operation is testament to America's reach and capability to take out terrorist threats no matter where they try to hide anywhere in the world. I'm determined to protect the American people from terrorist threats, and I'll take decisive action to protect this country. and will continue working with our close allies and partners, the Syrian Democratic Forces, the Iraqi Security Forces, including the Kurdish Peshmerga, and more than 80 members of the global coalition to keep pressure on ISIS to protect our homeland. We remain vigilant. We remain prepared. Last night's operation took a major terrorist leader off the battlefield, and it sent a strong message to terrorists around the world. We will come after you and find you. Once again today, we continue our unceasing effort to keep the American people safe and to strengthen the security of our allies and partners around the world. I want to thank you all, and may God bless you, and may God protect our troops. I'm heading off to New York right now. I'm late, and I thank you for your time. Appreciate it.
Mr. President, we've been listening to President Biden's comments on Syria and the death of the leader of ISIS. Let's get more now with Bloomberg's Washington correspondent Anne-Marie Hordern. So, Anne-Marie, frankly, this is a president that has had a few foreign policy blows as of late, but this is a win for him, and he's taking his opportunity to recognize it.
Yeah, it certainly is a major strike for this administration, probably one of the first big ones, and it's taking out the leader of ISIS. This is the second leader of ISIS. He's the successor to al-Baghdadi, who was taken out under the former President Donald Trump. That was in October 2019. When this leader came to power, there wasn't really a lot known about him. So it is interesting how they were able to do this in almost just under 2 years, basically just over a year's time. And this could potentially really help the president in the polls. We saw a shift in the poll numbers when President Donald Trump took out al-Baghdadi. Many people said that he deserved some of that credit, similar to when we saw former President Barack Obama take out Osama bin Laden. Massive uptick in the polls. So potentially, politically, this will look good on the administration.
In terms of the timing, obviously this is something that happened as a result of careful intelligence gathering, so you can't really pick the moment on which it's going to happen. But nevertheless, Anne-Marie, does this signal in some way a refocusing of attention by the Biden administration? The Biden administration has seen everything through the domestic policy lens. We've got Russia taking place, Ukraine taking place. We've got a lot of things to think about around Iran as well. Are we going to see this administration refocusing, do you think, on foreign policy in a more significant way?
I think they don't have a choice, right? Foreign policy at the moment is on their doorstep. They have no choice but to deal with the tensions in Eastern Europe and Russia. They've had no choice but to also make sure they are on top of what's going on in the Middle East, especially since many individuals and analysts were worried about a recalibration, a resurgence of what was going on in ISIS, especially the president mentioned there, under this ISIS leader, what had happened in that prison most recently in Syria and how it was under the direction of this leader. They've had no choice. But what was interesting is something the president said was about the reach and capability to take out terrorist threats no matter where they are in the world. And many individuals were critical of the administration when they withdrew from Kabul, saying they should have kept at least some troops there. Yes, it's in Asia, but it is very close, of course, to the Middle East. And when you talk about the U.S. Central Command point, Afghanistan would come under the Middle East for the military. Many said, how are we going to keep eyes and ears on what is going on in this region? Well, the President of the United States said just there that they are still able to do it, and they were able to take out the leader of ISIS. So politically, for the Biden administration, certainly foreign policy guide, to your point, is top of the agenda, but also this will play well for him domestically.
Does it also play well for him on the international stage when trying to form a coalition of allies to fight potentially the efforts and the tensions at Ukraine? I mean, how do you think our allies and also our adversaries like Russia are looking at this today?
So our allies, this is going to be welcomed, right, in the capitals in Europe. For Russia, it's an interesting play, of course, because they have taken the back of the Syrian leader, and that's where the ISIS leader was hiding out, in Syria. So I imagine this is also another point for the Biden administration when they are trying to talk tough on President Vladimir Putin.
And they continue to have to do so. Those headlines also constantly flying. Thank you so much to Bloomberg's Anne-Marie Hordern, usually in Washington, but here in New York for us today. And while it is an important day for politics and geopolitics, as they often seem to be, it is also a big day for the markets. Right now, Meta Platforms down 24% in U.S. trading. That rout is extending more broadly into tech stocks. Bloomberg's Abigail Doolittle is here with a look at that. Abigail.
It certainly is, Kaylee, spreading very broadly. If we take a look at the S&P 500,
off of its lows, but nonetheless down 1.1%. The NASDAQ 100 down 2%. And then the New York FANG index, that NYSE FANG index, down about 3%. It feels a lot more like January, and this, of course, breaking this 4-day rally that we had, the best 4 days since November of 2020. So the volatility, the whipsaws are back in effect. Today, the bears are clearly winning. And to your point, Kaylee, it has everything to do with Meta Platforms. If we take a look at a 2-day chart, here is this plunge. It's really pretty extraordinary, down 23% over the last 2 days. At the lows, down closer to 26%. Its worst day ever, going back to its not so great IPO back in 2012. Today, reminiscent of it. It's hard to find anything too good about this quarter. 0% growth. The outlook not great. Spending so much on the metaverse. Expected to drag on operating margins by 10% coming up. They're trying to spend on video. So this stock and company really having a hard time. In turn, it's really dragging on other big tech companies. And of course, Amazon reporting after the bell today, down 5.3%. This company, this stock, already in a bear market, down about 26%. Now, interestingly, all 59 analysts have buy ratings, but you can say that the expectations, it's a little bit choppy. It's tough here with some of these mega cap companies reporting well, others really disastrously. You can make technically the case that Amazon could go down to 2,100 pretty easily. It may suggest